Yes, what I'd like to ask them is I'm in a bit of a quandary at the moment. I actually own quite a large portfolio in Brisbane, and it's on the Redcliffe Peninsula. Some of it looks at water, and I've actually just purchased one right on the sand. Now, in view of the current marketplace, we're actually experiencing a low interest in rents, particularly at that middle to high end. And I'm actually looking to buy another property rather than buy something in that same area. I'm wondering whether it may be an option to actually perhaps spend even double that sort of money I would have to and go right into the inner city Brisbane area.
Lynette, from what you're saying, you're a pretty astute investor. You've got a substantial portfolio. So I'm sure you'd appreciate that there's two components when looking at returns on your investment. Only the smallest component is actually the rental component. The biggest component is your capital growth. So someone like yourself that's buying, premium properties in premium areas, I'm sure you'd have found that the capital growth on those properties over the years has been pretty substantial. Is that a fair call?
I've actually just purchased one and it sits on beach. It's actually right on the sand.
Yeah, but what we're saying is that historically, you said you've got quite a few properties in prime locations, is that correct?
Yes, that's correct.
Yeah. Have you noticed that you've had good capital growth over the last...
It's been tremendous.
Tremendous capital growth, right. So what I'm trying to get at here, my point is that you're saying that your yields, which is your rent coming back from that, is relatively low compared to the value, but there's always two components you need to up in your rate of return on your investment. The smallest component is your rent. The largest component is your capital growth. So going forward in 2 or 3 cycles, you will find, even though you've probably got less rent on those properties today, but going forward in 1 or 2 cycles, you'll well and truly outperform a particular property that you're moving closer to get a better yield on your current rent. So I'm on your side. I actually prefer the better capital growth. As long as I've got a decent tenant that'll look after the property, I'm not too worried about not getting the top dollar as a rate of return for my rent, but as long as I get good capital growth. So if I was you, I'd stick to properties that give you better capital growth long term, unless you've got a tight cash flow position today. But if that was the case and you've got quite a good portfolio, you can actually dip into the equity in those to service some of these debts in the short term and then pick up the capital growth when you revalue them, say, in 5 years' time.